This is David Kerans for Radio VR in Washington with a topic of some importance to anyone interested in how budgets should be handled at the national level. I'm talking with Professor, Specialist in Economics and Politics, Jack Rasmus, St. Mary's in California. We're going to discuss the fact that Portugal is leaving behind its dependence on IMF funding loan programs. Jack, can you describe to us how the situation is going in Portugal? I understand that the IMF, as is its wont, has imposed austerity programs. Portugal's employment has actually shot up in the last few years, something like 16%. 6% of the eligible workforce has actually evacuated the country, over 300,000 people. And now they're leaving behind the IMF, but I understand there's probably little reason to do a victory lap.
No, if you look at the real economy, Portugal's GDP declined 0.7% in the first quarter. I think it was the second worst, right behind Ireland in terms of decline, which also has left the IMF. The question is, does this leaving the IMF, i.e. dependency on IMF continuing loans, signify economic recovery or not? And my answer to that is the latter. No, it doesn't. What you've got is just an exchanging of government, i.e. IMF debt, for private sector debt. In other words, instead of borrowing from the IMF, the government now can sell bonds and borrow from private investors. So why are private investors buying Portugal bonds now when they weren't before? Well, before they were in the 15-16% range and very expensive and very risky at that prior level. But now they're around 5%. In other words, sort of a Goldilocks range, not so high that people have to worry about Portugal defaulting on those debts, but high enough that you have a nice spread now between Portuguese government debt and, let's say, German bonds, in other words, and UK gilts, also bonds, even U.S. bonds. So what you've got now is a rush of investors from Northern Europe, Britain, U.S., targeting periphery bonds, euro periphery bonds like Portugal, and looking for that spread and chasing yield because other investment opportunities, global stock markets have slowed down and are probably about to contract. China is slowing down. Emerging markets, capital is flowing out of emerging markets because of instability there. And they're flowing and targeting euro bonds, particularly periphery bonds. So you have all of these forces globally converging, and one of the few places where you can get a nice 3-4% safe return now is on Portuguese and other bonds. And investors globally are chasing yield, and this is the spot that they're going after. It's just moving the money around financially, though. It's not really having any effect and won't have any effect on the real Portugal economy, which unemployment's still above 15, close to 20%. Bank lending is still not recovering. Bank bad loans throughout the Eurozone are rising. Corporate debt write-offs are rising. And deflation is creeping. And that's another reason why they're chasing bonds. They expect that deflation is going to continue in the Eurozone. Now, Eurozone-wide, only 0.7% inflation rate and declining. But in Portugal, already negative. So deflation has already come to Portugal. And that combination of deflation with no real economic growth, actually negative economic growth now, high unemployment, and continuing austerity policies in Portugal means the real economy is not responding, won't respond, will probably get worse, and all this is a financial facade moving off of the IMF into private corporate debt.
Right. So I guess for a naive reading of the headline figures, namely that Portugal is able to get money privately, secondly, that the interest rate they're able to offer is now going down, so somewhere near 5% you mentioned, it would be naive of us to assume that this signals some sort of light on the horizon because that 5% rate is not merely a reflection or of the estimate of the risk of default. It also implies or depends on investors understanding that deflation is on its way inside Portugal, that perhaps there's some bailout might be possible to those investors. I won't assume that. But mostly that there is a surplus of capital now chasing limited opportunities to get yield, and what Portugal is offering is not really a reflection of the risk in the economy, which is pretty severe because not only do they have heavy unemployment, but they, as I understand, they're going to be pursuing austerity programs which stand to handicap their economy going forward. Do I have that right?
Yeah, that's pretty much similar to what I just said. And the point is that there's this global chasing of yield as these opportunities, commodities boom is, of course, over. The big stock market booms because they were fed by quantitative easing in the U.S., U.K., and elsewhere. Are coming to an end at some point soon. Japan's QE has run its course. Therefore, its stock and currency speculation opportunities are over. So, you look around globally, QE has pumped up financial asset prices and to a very dangerous bubble point. You can really see that in the UK with that false housing boom they are going on. So now the investors know those games have been played out, and now they're looking for another game. And one of the poor choices, but one of the declining fewer choices over time is this euro periphery play here, and they expect deflation to continue. So if you buy the bonds now, the prices are going to continue to rise, and this purchasing of bonds in the periphery of Europe is not only government bonds, but it's also chasing corporate high yield bonds, junk bonds in the corporate world, which is very dangerous. Because we kind of have a growing bubble in junk bonds in the U.S. and now very hot in Europe. All that means is that more and more debt is being taken on by businesses, by banks, and should another financial crisis emerge, we're right back. In fact, in some ways, worse than we were in 2007-8.
Sounds like we're looking at not merely the extension of difficulty in terms of austerity for Portugal, but you're tracing for us a picture of accumulating risk to the whole global financial system. I'd like to settle for a moment on what's going on in Portugal, not in detail, but just to point out, if I've got it right, that the IMF is really not going away right away, that Portugal may not be taking new loans, but it has to pay back the existing loans maybe for decades, and the IMF will be able to meddle in the sense of their officials and those of the European Commission returning to Portugal something like twice a year to review the state of its budget and look at what's happening. And by 2035, apparently, 75% of the IMF loans should be paid back. When we look at the influence of the IMF, and let's talk also about austerity here, are we talking about austerity programs in Portugal, in elsewhere in Europe, potentially other places in the world, which have a variety of self-destructive forms, namely the stripping out of public assets for auctions or bargain price sales to well-connected players, shrinking social safety nets, shaving down of socially productive public expenditures like education, and other productive expenditures like, you tell me. Are we looking at really self-destructive policies and austerity, or am I putting it too simply?
No, the IMF really requires countries that borrow from it. If you're going to borrow, you got to show us, the IMF says, that you can pay this back. So you've got to reduce your spending elsewhere. So what you've got is the government, laying off public workers, reducing public services, selling off public investment, nationalizations, and so forth, in order to reduce its expenditure and raise money to pay the interest on the loans that it borrows from the IMF. And what this really all amounts to is taking wealth and money out of the general economy and general households and turning it over to the IMF, which, of course, pays off the banks that are associated with it in making these loans. So it's a redistribution of income. That's what the IMF does. And, the next big example of an IMF ripoff that I've already written about elsewhere is the Ukraine. Ukraine's headed for a Greece-like depression. And that's the history of the IMF. If you want loans, you have to pay back the banks and us first, and that means you're going to have to squeeze everybody else. Now, the problem is that just slows down consumption in general and creates a stagnant economy at best and a continuing recession at worst. That's the historical example everywhere where this has occurred.
I think the educated public can thank, among others, Joseph Stiglitz, noted economist, Nobel Prize winner for alerting a lot of us, he's not the only one, to the way in which structurally the IMF, or conceptually, schematically I'll say, the IMF functions. I want to quote him in an interview we did a few years ago. He says, they were interested, the IMF, in one thing. They looked at the country in question and they thought, they need to repay the loans they owe to Western banks. How do we get that to happen? So they would never ask, should we give this developing country a bankruptcy procedure so they can have a fresh start? They thought that bankruptcy was a violation of the sanctity of contracts, even though every democracy has a bankruptcy law for people who have persistently failed. They were interested in milking money out of the country quickly, not rebuilding it for the long term. I could go on ad infinitum with the insights from Stiglitz into how the IMF functioned back then. He said at that time in that interview a number of years ago, they've gotten better, but there's a long, long way to go. You're telling me, I think you're letting us know that the IMF has not really changed its spots, and what it's offered to Portugal and what it may be offering now to Ukraine are not for the general interests of the health of the economy, but for paying back the Western banks. And, well, you tell me.
Yes, well, a good example is Ukraine. The most recent example, the IMF loaned there about $17 to $18 billion. Ukraine, of course, has two previous IMF loans that it's still paying off. $6 billion of that $17 billion is going to go to pay Western banks' previous loans. So the Ukraine's going to be left with $11 billion, but a lot of that's going to go to Ukraine's central bank in order to make purchases to keep the currency from declining too fast, and also to finance exports. So you're really going to have about $6 or $7 billion available for the general economy, but then the IMF's terms and conditions are such that gas subsidies have to be eliminated. Public workers have to be laid off, and in general, you're going to take about $30 billion out of that economy to put about $6 billion in, which means they're going to need more IMF loans down the road. I've estimated they're going to need about $50 billion in Ukraine. But that's fine with the IMF and the Western banks because they keep making interest on those loans. Like you say, you get into them and you'll get deeper and deeper into them, they'll have that much say over what your economy is going to look like and who's going to get the loans and who isn't.
I recall Stiglitz pointing out that at one point, I think it was Lula in Brazil, was able to resist the IMF. He had them over a barrel in a sense because Brazil owed them a lot of money, and Lula was in a position, he could bargain from a position of strength, and he could avoid, he could risk the idea of not paying back those loans. Is the Ukraine, I'm not asking you to reveal every secret or have a crystal ball in front of us, but is the Ukraine in position to reject IMF entreaties? They already owe a lot of money. Could they default? Stiglitz said at one point, he said, listen, no agreement is better than a bad agreement with the IMF. Do we know how many cards the Ukraine has to play? The government's still taking shape. The borders are still taking shape. What can you tell us about the degree to which they could resist IMF pressure?
Well, they tried to resist the IMF here back in December, and we saw the political upheaval that resulted in. And then, of course, the IMF and the ex-president Yanukovych came to a deal, and then immediately within 24 hours, there were forces that believed that wasn't sufficient. The IMF deal that was offered. The provisional government and the government after May 25th election will have very little bargaining power because the people who are probably going to be in positions of government are really very close to the Western banks and U.S. and EU global financial interests. So they're going to probably do whatever the IMF and whatever the U.S. and EU want them to do. I don't think they're even going to try to bargain. If they have any bargaining chips, it's It's letting these Western interests into their real economy in those sections of the Ukraine economy that they really want to get a toehold in the energy section, in electronics, and so forth. People don't realize Ukraine is a lot more than agricultural. There's a lot of very key industries globally in the Ukraine, and I think Western interests want to become 51% partners in those key industries.
Right.
Part of their global planning. So if there's anything they have to bargain, if they feel so inclined, I don't think they will. Obviously, Poroshenko looks like he's going to be the candidate. I don't know. I don't see that they have much bargaining power because they're going to need another, within 18, 24 months, another major IMF loan.
Right. In the 2.5 minutes we have left can you offer a thought or two on the state of political, or rather economic, theory that's regnant in Washington now? Do you see a zeal for austerity, be it in the form of the Paul Ryan budgets we saw in 2012? Do you see that accumulating strength, or would you sense that the political winds are moving in the direction of more towards Keynesian economics now, or is my question too simple?
Oh, I don't think they're moving towards Keynesian economics. I think they're waiting for the election to move on big corporate tax cuts for large multinational corporations. I think that's the next fiscal move. As far as deficit cutting, I don't think you'll see that until after 2016 emerge once again, if then. But I think the whole idea of corporate tax cuts, both Obama and Republicans, even before the 2012 election, were on record for cutting the corporate tax from the nominal 35% to about 25 to 28%. They claim that's because U.S. corporations are paying more globally, which is not true. If you look at the effective rate, I wrote an article a couple months ago, The Great Corporate Tax Shift. The effective rate of U.S. corporations is somewhere around 12%. Paying of U.S. federal income taxes, about 2-3% on state corporate taxes, and no more than 3% on global taxes to other countries. You can see moves by Pfizer with AstraZeneca trying to purchase, and all these corporations are attempting to establish offshore headquarters so they can take advantage of these foreign tax loopholes, and there's a big rush to do so on their part. So I think the argument will be right after the November midterm elections here coming up. We need to cut corporate taxes because the nominal rates of the U.S. is so much higher than other countries, but when you look at it, the effective rate is not.
Yeah, well, I think we can look to the period after the elections, not with hope, but with real trepidation. I want to thank you, Jack, for offering a lot of insights on austerity, on the IMF, on Portugal, and on the climate of economic thought in the United States as it is developing. That is Jack Rasmus from California at St. Mary's. Thank you, Jack.
My pleasure.